Hello everyone, Cian here, and this is my summary video about the first core content episode of month 3, and that is timeframe selection and defining setups. Timeframe selection. So we have the monthly charts, so that is mainly used for position trading. The advantage of the monthly chart is that you don't really have to be precise with your entry, and the trades you take are very big. And note that the only entity that has enough power to move price quickly on the monthly time frame is smart money. Weekly charts is mainly used for swing trades. Expect 1 to 2 trades per 3 months, so a little less than 1 trade a month. Daily charts are mainly used for short-term trading, and smart money is most visible on this time frame because they execute on this time frame, so we can clearly see sensitive levels on the daily time frame. And yeah, the daily chart frames every lower time frame setup. And 4-hour charts or less are used for day trading or intraday trading, and time of day is very important. Defining setups for your model. If you are a trend trader or a long-term trader, trading only in the direction of the monthly and weekly chart is what you should do. When you are a swing trader, then you just have to trade the daily chart, but you also need a lot of patience with this. But the trades are very big. And contrarian trader is someone who trades reversal patterns at market extremes. So they don't have to be tops and bottoms, because small retracements also work. But every time when price retraces or reverses, this is where a contrarian trader looks to enter. So a short-term trader is trading the weekly ranges, so the weekly profile, and the day trader takes intraday trades with exits before market close, so that is 4 p.m. for indices. And you have to ask yourself, what trader do I want to be? But that depends on your level of patience, what your attitude is, and life. You can make a decision, I want to be this trader, but then after a couple of months you might come to the conclusion that you are actually a different type of trader. So, you can make a good decision on what you think best suits you, but keep in mind that it can change later on. Some general notes. The higher the time frame, the more important the PD arrays. One day, everything will make sense. So you'll know what trader you want to be and what setups you want to trade. Because I already said, you can make a decision of what type of trader you want to be right now. But, just by doing it and just failing, you have to make mistakes and just look at these mistakes and look why did they happen and how you can prevent them in the future. And that will also decide, maybe you made the wrong decision. Maybe you are a different type of trader that you thought you were. And what will your setup be? The one you can see the easiest. Because in ICT concepts, you have a lot of different PD arrays, but people always ask, what PD array should I trade? You should just trade PD array that you see the easiest. Because if you have to force yourself to see things in the markets, that is never good. And finding your daily bias isn't the hard part, but trusting it is. So trust your bias until you're clearly proven wrong. So you have to have a invalidation level where you say, when price trades above or below this level, then my trade idea is wrong. But until then, you have to trust your bias, and it's very hard, but it's very important. And you want your setups to take longer to form than to actually take profit. So in a market maker model, you actually want the left curve take longer to form than the right curve to hit your TP if you are targeting that original consolidation liquidity. You can draw a range from the smart money reversal to your original consolidation. You can put your Fibonacci on top of this, and you can put the 75%, 50% and 25% levels on there as a setting, so quarterly levels. And we can do this, so when we draw this range on the left curve of the market maker cell model, then we can anticipate entries, pyramid entries on the right curve around these levels. So here's an example. We have the 75% level right here. Around the 75% level we have an entry opportunity. around the 50%, we also have this entry opportunity right here, and around the 25% level, we also have a entry opportunity right here. The difference between a liquidity pool and a market structure shift. When price trades toward a higher time frame PD array, don't see the swing high break as a market structure shift, but as liquidity, buy-side liquidity into a higher time frame PD array. So when you don't go from higher time frame to lower time frame, then you will actually see this as a market structure shift, right? But if you actually go to a higher time frame, you will see that this is just the bottom of this 4-hour CB, so it's also buy-side liquidity. Price just wants to go take this, sweep this level, and trade it to this higher time frame FVJ, and then go clear lower. So you have to understand that looking at different time frames is very important. Always go from a higher time frame to a lower time frame to validate your trade IDs and do your analysis. Thank you for watching this video. Don't forget to like the video and subscribe to the channel. See you next time.